A lot of traders are looking for the perfect trading setup, thinking that the setup and the entry is the key to success. And to all those people who believe that is the missing variable, and once they find that, their path to riches will be shown, trade entries are just one element to a successful trading strategy. And there's certainly a lot more that needs to go into a winning strategy, such as your position sizing, your exit strategies, and capital management. And some traders will look to always improve their entries to help cut down on the number of losing trades. And that shows that not everyone has a productive view on trading entries. But you have to start a trade somehow. And since trading is a sequential event, the entry is the first part of that sequence. A poor entry could make everything else you do in the trade just a little more difficult. And when traders hear about risk, they look at just how much they can lose in a trade. But risk can also be the likelihood that your trade will be stopped out. And this is a big concern for those who trade with small accounts. And I find it really common in forex, especially where traders will place their stops a few pips around market structure or individual candlesticks. And this is done because these traders need a tight stop to enable a larger position size. And while there are trading strategies that take many losses but have a few large winners, imagine what constant stop loss triggers can do to a trader's confidence. Losses add up, and when you factor in spread cost or commissions, the amount of money you put up for the trade is actually a little larger than your set risk percentage. So what the risk of taking a loss comes down to in the simplest of forms is this. How hard does the market have to work in order to stop you out? And so what are the chances you're going to be stopped out on any given trade? Now, there are two ways in which this works. The first is the level of preceding activity that's present at or close to your entry. And this often ties in with the second way, which is market structure, where supply and demand have previously been present and therefore could be present again in the future. Now, market structure is what I want to concentrate on here because I think it's a concept that many traders actually understand. Structural risk is how likely the market is going to be able to stop you out based on where your stop is with respect to levels. If your stop is above support for a long trade or below resistance for a short trade, the market is going to have an easier time taking your stop. You can see here really clearly that there's a static level around 82.83. Now let's say that your strategy is giving you a trading signal to go long and you have a normal stop of around 20 to 25 ticks, which is 10 to 12.5 points. At the maximum of 12.5 point stop, your entry has to be a maximum of 82.95 to avoid the 82.83 level. But then it's clear that this level is not to the tick. You'd probably want to give it at least another 2 to 3 points, and that would take you to 82.81 and an entry of, at worst, 82.93.5 to a chance of the market retesting what looks to be recently the most important level before actually turning around and moving to target. And below 81, you're probably going to be wrong, as if the buyers are still in control. That's the place you'd want to see them entering again. Now, I'm not going to discuss trend lines because they can be really similar to standard static levels, just with the fact that they change over time thrown in. And what might not be so obvious is the way in which the market normally ebbs and flow as it moves. Now, everyone knows that markets more often than not don't move from A to B in a linear fashion, but instead they meander their way back and forth until they reach point B. What the normal level of this behavior is will be specific to the instrument in question and the time frame that you're focused on. On this chart here, it's a simple swing indicator that's been added to the chart to illustrate this action. And you can see there are some big moves between the high and low extremes, but there are also some smaller swings that are there as well. And if you were to analyze this, you'd see that there's a general range of how large these swings are before a counter swing happens. So let's say, for argument's sake, that a standard swing is 25 to 35 points on this time frame that we're looking at. If you have a strategy which goes with the direction of the current move and the amplitude of using the current swing is on the upper end of normal, like 30 plus ticks, then there's a good chance that your trade will endure at least a high level of MAE, which is maximum adverse excursion, or be stopped out entirely before the market gets to your original target. How many times have we all seen a good trade stop out before the market moves to target? It's not avoidable, but if it's happening on a regular basis, then there's cause to adjust the way that you're entering your trades. And for those who run backtesting software, this is why it is important to actually take a look at the trades that have been generated to see how they have happened, not just what the outcomes were. In my own trading, I often use something called symmetry and corrections, where I measure the length of pullbacks that have occurred without violating the current trend. And very often you will find corrective declines or corrective rallies around the same price differential. And this can be used in placing stops and or finding your trade entries. The market moves based on its own structure, not yours. So your risk has to be defined not only by the maximum amount you can lose, but also where you're likely to be wrong. And the reality is that you work in the market's universe, not the other way around. By taking the time to look at where your entries are relative to structure and working with it, you are able to mitigate some of the risk that is associated with trading and improve the quality of your stop outs. You can be wrong where the market's likely to agree that you're wrong. Now, entries, they're just one step in any strategy, but nevertheless, they are important in managing your risk.